Most investors lose millions because they wait for the next big stock, but the real wealth is hidden in a compounding engine that operates while you sleep. I spent 3 years stress testing dividend reinvestment strategies to find the exact mechanism that turns small payouts into massive generational wealth. Forget picking winners or watching tickers. I'm going to show you the 3 specific steps to automate this machine so your portfolio grows even when you aren't looking. That turned $1,000 into over $4 million for long-term holders of companies like Coca-Cola. And the third method? It is the secret weapon of the world's most successful long-term investors, and it works better than the other two combined. So sit back, grab a cup of water, and let us get to it. Let us start with the basics, because if you do not understand the math, you will not have the patience for the results. Dividends are cash payments companies make to their shareholders, usually from their profits. When you receive a dividend, you have a choice. You can either take that cash and spend it, or you can use it to buy more shares of that same company. This is called a dividend reinvestment plan, or a DRIP. When you reinvest those dividends, you are buying more shares. Those new shares then pay their own dividends in the next quarter. This creates a flywheel effect. You are not just earning interest on your original investment, you are earning interest on your interest. That is the definition of exponential growth. The first way to do this is the easiest, the built-in broker reinvestment. Most modern trading platforms like Fidelity, Charles Schwab, or Robinhood have a simple toggle button in your account settings. You go into your account, find the dividend reinvestment section, and flip that switch to on. That is it. From that point forward, every single dividend you receive is automatically used to purchase fractional shares of the stock that paid it. You do not have to lift a finger, you do not pay commissions, and you do not have to time the market. It is the classic set it and forget it strategy. Think about my friend Marcus. He started investing in a high-quality dividend growth stock back in 2012. He was not rich. He was just putting away $200 a month. He turned on his broker's automatic reinvestment setting and just let it run. 10 years later, without adding a single extra penny outside his base contribution, his share count had grown by 42%. The power of those extra shares meant his dividend checks were significantly larger than they would have been if he had just pocketed the cash. It is an easy win, and it builds your portfolio while you sleep. But what if you want to get more tactical? This leads us to our second point, the manual dividend rotation method. Some people feel that the automatic broker setting is too passive. They argue that by automatically reinvesting in the same stock, you are constantly buying shares even when the price is at an all-time high. They prefer to collect the dividends in cash, let the money sit in their account as a cash reserve, and then wait for a market dip to deploy that capital into the best valued stock in their portfolio. This requires more effort. You have to track your account. You have to be disciplined enough not to spend the cash on groceries or a night out. But the data backs this up for disciplined investors. A 2020 study from the Journal of Financial Planning found that investors who wait for market corrections to reinvest dividends can increase their long-term return by nearly 1% annually compared to static reinvestment. That might sound small, but over 30 years, 1% is the difference between a comfortable retirement and a wealthy one. You are essentially using your dividends as a dry powder reserve, waiting for the market to give you a discount on your favorite companies. If you are finding this helpful, hit subscribe. I drop videos like this every week to help you get more out of your money. If this is clicking for you, a quick subscribe helps me keep making these, and stick around because the best part is coming up next. Okay, remember how I said the best one was coming? Here it is, the total portfolio rebalancing strategy. This is the one I've been saving for you. Most people treat every stock in their portfolio like a separate bucket. They only reinvest dividends back into the stock that paid them. But the best investors don't think in buckets. They think in percentages. Imagine you have a portfolio with 3 core sectors: technology, healthcare, and energy. Your target is to keep each at 33%. But during a market cycle, your technology stocks might soar, becoming 40% of your total wealth, while energy stays flat. If you just reinvested your technology dividends back into technology, you would become even more overweighted in a high-price sector. Here is what you do instead. You take the dividends from all your companies, pool them together in your cash account, and then you look at your portfolio's current allocation. You then manually direct that pooled cash into whichever sector or company is currently underperforming your target allocation. You are literally buying low and selling high with every single dividend payment. This forces you to rebalance your portfolio automatically, every quarter, without ever having to sell a single share and trigger a capital gains tax event. It is genius. It keeps your risk managed. It keeps your target allocation on track, and it ensures you are always picking up shares when they are cheapest. Let that sink in. That one shift alone could save you more than the first 2 methods combined, because it optimizes your risk profile while maximizing your buying power. Once you see it this way, you can't unsee it. So there you go. 3 real ways to handle dividend reinvestment, and that last one alone could change your entire financial picture. You start with the automatic broker switch to build a habit, move to the cash reserve strategy if you have the discipline, and graduate to the portfolio rebalancing method once you are ready to take control of your asset allocation. It is not about timing the market, it is about staying in the market and keeping your engine firing on all cylinders. If you got value from this, share it with someone who needs to hear it, and subscribe so you don't miss the next one. I am working on a follow up about the best high yield sectors to look at for 2025, and you won't want to miss that. Thanks for sticking with me until the end. Now go check those account settings and make sure your money is working as hard as you do. Before you go, think about the compound interest calculators you see online. They always show that exponential curve at the very end. That is not luck. That is the result of years of consistent automatic reinvestment. It is the boring path, but it is the surest one. Stay consistent, keep your eyes on your targets, and let the math do the heavy lifting for you. You have everything you need to start today. Get to it. And remember, true wealth isn't just about how much you make. It is about how much you keep and how fast you can make that money grow. By turning your dividends back into more shares, you are essentially buying a new tiny business every few months. And those businesses then buy more businesses for you. It is the closest thing to a get rich slow scheme that actually works. See you in the next one.